The repercussions of the war in Ukraine have continued to impact the stock market in the month of March. As Western nations moved swiftly to punish Russia for its unprovoked attack on the democratic nation of Ukraine, investors started to worry that the geopolitical conflict would slow down the global economy, leading the stock market to fall. This fear is reasonable because Ukraine and Russia together account for 1/4 of all global wheat exports, and Russia alone is one of the largest oil and gas exporters in the world, accounting for nearly 40% of all natural gas used by Europe comes from Russia. As these commodities and others have become harder to attain due to the war and the sanctions, their prices have skyrocketed. In fact, oil prices have risen to the highest level ever, and most American households are now spending 5 to 10% of their incomes on gasoline, with lower-income families spending a larger share. If these price increases continue, it will eventually lead individuals to reduce their spending, whether that is eating out, traveling, or buying clothes. This is problematic, since 70% of the U.S. economy comes from consumption. The one silver lining is that many large military conflicts in the past have not derailed the stock market over the long run. For example, when looking back at 10 large military conflicts since 1940, the S&P 500 dropped on average of 2.3% in the month following the start of the conflict, but was 10.6% higher on average a year later. Let's hope the stock market has the resilience to shrug off this war as well.